Have you ever wondered why the central banks increase interest rates when there's a high inflation rate? All right, so inflation rates and interest rate are two, economic factors that actually move in sync. So when inflation rate is going up or increasing persistently, the central bank of any country would want to raise interest rates, right? And the relationship between interest rate and inflation rate and is what I'm going to explain to you in this video. Please stay with me. First, let's start with inflation rate. What is inflation rate? All right, so basically inflation rate is when the general price of goods and services are actually increasing, and the essence of that, or the implication of that, is that your purchasing power will fall. So meaning that the same amount of money you have will no longer be able to buy as much as you used to buy, basically. And that's what inflation rate is all about. So let's talk about interest rate. When you talk about interest rate, what does it mean to you? So interest rate is simply the cost of borrowing fund. When you borrow money from the bank or when you're investing money, the amount they pay you as interest or the amount you pay on your loan is simply what you call interest rate. So the relationship between this interest rate and inflation rate in any country is what I'm about to discuss in this video. Please stay with me. So how do they actually interplay? So every time that inflation rate increases, every central bank will raise interest rate. Why are they raising interest rate? They are raising interest rate to actually adopt what you call a contractionary monetary policy. Contractionary in the sense that you are trying to mop out excess liquidity from the economy. So now, how do they do this? Now, when interest rate increases, it means that borrowing becomes more expensive. People will not want to borrow again. And also when that increases, when interest rate increases, it becomes an incentive for people to deposit their money in the bank. Currently in Nigeria, I think treasury bill is currently close to like 23%, 22%, and everybody is rushing to go and put their money, with federal government on treasury bill and the rest of them. So what they have done basically is that they have created an incentive to help you bring your money. And the more money you bring into the bank, definitely is reducing the quantity of money in circulation. And when this happens, it simply means that you now have fewer money chasing the goods and services that we have, and by so doing, the quantity of money in circulation is reducing, and so a lot of people are now bringing back their money. And also for those borrowing has become so expensive. What it simply means is that you can't just go to the bank and say you want to borrow except you have any serious business or any genuine business to do with that money. And in fact, to even get borrowing now, I think in commercial bank, the borrowing rate is getting close to 30%. So if this happens, what are you investing that 30% interest, amount you're borrowing, and that will give you up to that 30%, right? So it's actually a very, very difficult thing. So what it means that even companies, entities are no longer borrowing from the bank. And the reason is simple. If you borrow at 30%, what are you going to invest this borrowed fund on that will give you a return that is actually higher than that 30%? Otherwise, actually be making loss, right? And so since borrowing has become expensive, nobody is borrowing again, and so the demand for money has actually reduced, and so people are basically putting the money that they have in the bank, and the essence of that is to actually get interest on their savings. And this is why any central bank will continue to increase interest rate as long as inflation rate is high. And the reason for that is simply to reduce the quantity of money, or the volume of money that they have in circulation. I hope this video makes sense to you. See you again in the next video.